Hello student, my name is Dr. Athar Iqbal. This is continuation of our previous lecture which we carry on the stock valuation chapter. In this lecture we will cover supernormal growth model under dividend discount model concept. Remember that this is somehow quite tricky as compared to our previous lecture in which we cover various fundamental concepts of stock valuation. In this lecture we will cover a supernormal growth model of stock valuation. Remember that in supernormal growth model, the dividend will fluctuate. Sometime it will be at zero, sometime it will be on a higher rate and then gradually will decline. When you're working on supernormal growth, keep one thing in your mind, that whatever dividend you will receive, irrespective of you're receiving in the first year, second year, and so on, then current price will always be calculated with the help of present value of all future inflows. Future inflows means all the dividend that you will receive on this stock as well as the price at which you will sell it. So present value of all the dividends as well as the price that you will receive. Just take this question to understand that how dividend will fluctuate and how we calculate it. This company paid last year $2 as dividend. So this dividend will be taken as D naught. Further, investor expected dividend growth 20% for the next 2 years. So this is important that this 20% growth factor is not applying on a constant basis. This 20% will only be applied for the next 2 years. And then dividend is growing at a rate of 10% for the next 3 years and 5% forever. So student, this is the place where we can say that now the dividend is constant. Otherwise, in the first 2 years, dividend is growing by 20%. Then for the next 3 years, it is increasing by 10%. And after that, it is at a static level of 5%. Now, currently the requirement is only to calculate the future dividend payments. So the objective of this question is to give you idea that if dividend is fluctuating, then how we calculate it. Just look at this figure. Carefully see that right now the dividend which is given is 2. So I am taking it as D naught. And then it will grow by 20%. So for the D1, we will take this 2 and multiply by 1.2. So you will get this 2.4. Then student, on this 2.4, we will apply the 1.2 factor to calculate 2.88. And on this 2.88, since after 2 years, the dividend is growing by 10%. So you will take this 2.88 and multiply it by 1.10. When you will multiply this 2.88 by 1.8, your dividend will be 3.17. And then you will apply the similar practice for the next 3 years. So 1.10 will be applied on this one to get 3.48, and then 1.1 will be applied on this one to get 3.83. On 3.83, you will apply 5%, that is 1.05, to calculate the 6th year of dividend, and that is coming 4.02. This is a mathematical working that I am showing here for your convenience, that D naught was given 2. Then for D1, we are taking 2 and multiplying it by the 20% factor. So there are 2 ways to calculate this one. Either you can apply 20% on this dividend and then add on the 2. The second, which I think is more convenient, is to simply multiply this $2 dividend by 1.2 factor to find out the next dividend. And so on, you will apply various factors as given in the question to find out different dividends. This is the demonstration of a supernormal growth model question in which I am keeping it at 2 different levels. Of course, it will somehow be more difficult compared to previous questions, but if you will put your concentration, then you will be easily able to understand how we will calculate it. Just look that currently the company paid $1 dividend, and investor believe that this dividend will grow by 15% for the next 2 years. So for the next 2 years, we will apply 1.15 factor, and 3 year from third year company will pay you 10%. After third year, the dividend will grow by a 5% thereafter. It means the dividend will not remain static. For the first 2 years, it is increasing by 15%. Then it will increase by 10%, and in the last, it will remain constant at a rate of 5%. Question is asking what is the maximum value investor can pay for this stock if the required rate of return is 15%. So initially, we will calculate dividend as we practiced in the previous question. You will take D naught as 1. Then you will apply 15% growth factor for the next 2 years, that is for the D1 and for D2. And then as question was showing that in the third year dividend will grow by 10%, so I am taking 1.10, and for the D4 I am taking 5% as given in the question. Once you have computed all the dividends for the coming years, you will be able to calculate P3. P3 will be calculated with the help of D4 divided by R minus G. Remember that you will apply this formula, keeping it in mind that when you were calculating P naught, you were taking D1. So in whatever year you are interested to calculate price, you always take dividend of the next year. So when I am interested to calculate P3, I am taking D4 and I will divide by R minus G. So D4 as given in the previous slide is 1.52. R was given in the question 0.15 and growth rate was 0.05. So P3 is coming 15.2. Now this is the actual work as we discussed at the initial stage of super growth model, that when dividend is fluctuating, so you will calculate dividend for all the years when dividend is fluctuating, and once it is going to be constant at that year, you will calculate price, and then you will calculate the present value of all the cash flows you are receiving from the company in terms of dividend as well as in terms of price. So I am taking all the D1, D2, D3 and the P3 that I calculated on the previous slide. Then as per investor required return, I am applying the 15% rate. So this is the present value factor that will come, and then you calculated present value factor for all the years, and take care that D3 and P3 will take the same discount factor. Once you will multiply this one, so this is the present value, and once you will add all these values, your P naught will come. Remember that when you are reaching to this P naught, keep it in mind that you will calculate all the dividends that you are expected to receive in the next years, and you will calculate price in the year when dividend is going to be constant. And since we need present value of all future cash flow, so this is the present value interest factor that I calculated with the help of investor required return that was given in the question 1.15, and these are the discounted values. Once you will sum it, so your price will come out.